Listen, if you are still staring at that damn CPI data grinning like an idiot, thinking your so-called growth stocks are about to take off because of rate cuts, then you are the fattest turkey on Wall Street. As dinner table tonight. Today is the 14th of January, 2026. Remember this date. No matter how mainstream media, CNBC, Bloomberg, or those analysts who only read press releases, sugarcoat things, talking about inflation under control and soft landing imminent, I am going to show you one bloody fact, Wall Street. S-Heart. Just skipped a beat. Even if you know nothing about finance, you must understand this common sense. JP Morgan Chase, ticker symbol JPM. It is not an ordinary bank, it is the Federal Reserve. S-Shadow. It is the cornerstone of the global financial system. It is that fortress supposedly never to collapse. Without any overt breaking news, a $2 trillion market cap giant plunged over 4% in a single day. This is like sailing on calm seas and suddenly watching an aircraft carrier sink. You call this normal volatility. Don't be ridiculous. Those experts currently analyzing CPI subcategories for you, telling you how much rental weight has decreased. They were either stupid or malicious. They were using tactical diligence to cover strategic collapse. Let me tell you what the real logic is on the trading desk. This so-called CPI cooling, at this timing, is absolutely not bullish. In today, as 2026, inflation declining has only one explanation. The demand side completely collapsed. Consumers have no money. Businesses aren't expanding production. The economic engine stalled. The market's expected rate cuts aren't because the Fed is benevolent. It is because if the Fed doesn't cut rates, the entire system will go into shock. But what is more terrifying isn't macroeconomic weakness. It is bank stocks leading the decline. Think about it. Why banks? Why today? When markets expect rate cuts, theoretically banks' funding costs decrease, which should be bullish for banks, right? That is what textbooks say. But today, the market's response is, run for your life. This reveals an extremely horrifying deeper logic. Wall Street is pricing in a massive default wave. That 4% drop isn't T-stock price adjustment. That is smart money provisioning for imminent bad debts. They know things we don't. T-no. Maybe commercial real estate. CRE corpses have already floated to the surface. Maybe massive credit card debt default rates broke through critical thresholds. JPM's plunge means even top. Tier predators are starting to feel cold. And when lions begin trembling, antelopes like you and me aren't far from being torn apart. What does this mean for you? Oh, I don't. Buy JPM stock. What has it got to do with me? If you think this way, you are truly too naive. Bank stock crashes are the starting gun for credit crunch. Starting tomorrow, ULL discover this world. S-money became expensive, even disappeared. Fee running a small business. ULL find your previously promised loan renewal suddenly blocked by bank managers with various reasons. Planning to buy a house. ULL find mortgage rates nominally dropped, but approval standards became absurdly strict. So still using credit card balance transfers? Be careful. Banks might suddenly lower your limit, directly breaking your cash flow chain. This 4% drop is the edge of that black hole sucking up global liquidity. And there is something even weirder. Did you see today, as precious metals market, gold and silver both hit new highs? Safe, having capital frantically flowing in, meaning someone smelled gunpowder. But, note that but, gold suddenly reversed and plunged from highs intraday. Why? Did safe having sentiment fade? Absolutely not. This is what sends chills down my spine most. In the early stages of financial crisis outbreaks, a phenomenon often occurs. Sell everything that can be sold to fill the biggest hole. Gold is good stuff. It is the most liquid asset. When bank trading desks face massive margin calls, when they lose their pants on some huge derivative bet, they have no cash left. They can only dump their most profitable assets to survive. Gold's plunge isn't because gold became worthless. It is because someone urgently needs cash to put out fires. This isn't just a pullback. This is someone amputating limbs to survive. If you can read this signal, you'll be like most retail sheep rushing into the stock market in the CPI bullish illusion, catching that falling blood-stained knife. Don Rush. This is just the trap. As surface behind this 4% plunge, who exactly is pressing the sell button? Where is that invisible hand trying to lead us? Fasten your seatbelt. What comes next might overturn your understanding of the word manipulation. We're re-entering a carefully designed game within a game. Okay, let's pull perspective from that suffocating market panic. I am taking you into this building's basement, where there is no light, only servers humming like beast breathing, and those people who truly decide your fate. Many ask me, if this is really a crisis, why isn't anyone saying so in the news? Naive. When the Titanic hit the iceberg, first-class passengers were still dancing waltzes. Only the boiler room workers knew water was coming in. And today, JP Morgan, S4% plunge red candle is the first scream from the lower deck. But here is a huge paradox. Also this game, S most exquisite, most vicious part, why on this day when CPI data was released and markets generally considered it bullish. This is no coincidence. Absolutely not coincidence. Wall Street has a specific term for this, liquidity hijacking. Imagine if you are a Wall Street whale holding hundreds of billions in commercial mortgage-backed securities, CNBC about to become waste paper, or a pile of junk bonds ready to explode anytime. You want to run, you want to dump these toxic assets. What do you need? You need counterparties. You need someone to buy. In this market, who is the dumbest? Who buys when everyone is selling? Exactly. Retail investors staring at economic calendars watching data. And those quantitative algorithms with rigid code. This morning at 8:30, CPI data released inflation cooling. In that instant, millions of trading bots read the bullish signal retail investors saw, rate cut hope, so buy orders flooded in like tides. This is the liquidity whales were waiting for. The very second you rushed in to catch the rebound, that person who already had fingers on the nuclear button pressed sell. JP Morgan S plunge isn't T because they suddenly discovered poor performance today. Institutions of this caliber knew their balance sheets crystal clear 3 months ago. They chose to dump today because only today has enough retail capital to catch their bloodstained chips. This is a perfect ambush. You thought CPI cooling was the savior. No, that is the smoke bomb released when main forces retreat. This explains why gold made that bizarre, inverted V pattern. Gold is the world's most honest asset. It doesn't lie. Early rally was smart money seeking safety. Intraday plunge was because someone in this game screwed up. Listen, this is crucial. When a major institution, let us assume some aggressive hedge fund or some shadow bank leveraged to the max, fails betting on bank stock longs, gets blown out by JPM, S plunge, brokers call them with just one sentence, post margin immediately or forced liquidation. They re-out of cash, can T, sell bank stocks dropping too fast, bonds unwanted. The only thing in their hands that can immediately liquidate has best liquidity hasn't T dropped yet. Gold. So they reforced to tearfully dump gold. This is why, in real crisis early stages, gold often falls alongside stocks. This is called deflationary deleveraging. This isn't T just price volatility. This is the sound of someone being carried off the field. Can you hear bones breaking? That is the sound of leverage snapping. Let us extend our view a bit. Look at history. History always rhymes. Remember March 2008, before Bear Stearns collapsed? The Fed was also cutting rates. Markets also cheering, rescue coming. Wall Street executives then were also on television solemnly declaring, our capital ratios are very healthy result. That was hell. It's beginning. Or look at Silicon Valley Bank in 2023. 48 hours before its bankruptcy, markets were still discussing tech bull market. The 14th of January, 2026. Right now, the air smells exactly the same. JPM is America. S largest bank, its balance sheet is a hologram of the US economy. If even it is suffering heavy damage, what does this mean? This means the underlying bad debt tsunami has already overflowed the seawall. Think about it. These past years, America maintained a so-called high interest rate environment, thousands of companies barely surviving by rolling over debt. And now, early 2026, massive corporate bonds are maturing. Commercial real estate vacancy rates have reached undeniable levels. JPM's 4% drop is pricing for imminent massive defaults. They retelling insiders game S over. We reconverting chips to cash. Even at a loss, we need cash back. And most ironically, meanwhile, silver still holds high positions stubbornly. Why? Because the silver market is too small. Major institutions haven T-completed distribution inside yet, or physical silver shortages make shorts afraid to easily smash prices. This forms an extremely dangerous crocodile mouth pattern, violent gold. Silver ratio fluctuations are often harbingers of systemic collapse. Now understand who pressed the button, not some specific villain. It is the cycle, that inviolable debt cycle. But those using this cycle to harvest, you have names and faces. Look at today, S volume distribution. While JPM plunged, R&T some defensive sectors, like utilities, defense, quietly accumulating. R&T some short volatility ETFs being frantically redeemed. These people, while telling you buy the dip on CNBC, they frantically dumping bank stocks in dark pools, simultaneously shorting the S&P 500. They exploited your desire for rate cuts, locking you on the mountaintop. This is T-just financial war. This is psychological warfare. They rebetting you don't dare believe. Collapse will really happen. They rebetting you LL self. Hypnotize watching CPI data. Once you accept this setup, you are already in the game. In this game, JPM is the first falling domino. but it is definitely not the last. Its falling direction points straight at that $600 trillion derivatives market. Want to know where the circuit board will smoke after that button? S pressed. Want to know where the only shelter is in this man-made avalanche. Now, turn off those noise-filled news channels. Lock the door. Every word I say in the next few minutes might determine whether you become negative net worth or complete class transition over the next 3 years. Since JP Morgan, the lead sheep, has already broken its leg at the cliff edge, domino collapse is already a physical inevitability. We don't need to guess whether it happens. We only need to calculate when the shockwave reaches your doorstep. Let me project the script for the next 72 hours to 30 days. Stage 1, repo market, cardiac arrest, next 72 hours. Since JPM plunged 4%, this means the mutual trust chain between banks broke. JPM is one of the biggest funders in the repo market. When it starts contracting front lines, overnight repo rates will suddenly spike like September 2019. What will you see? ULLC stocks experiencing inexplicable flash crashes, then mysteriously pulled back up. That is the Fed desperately injecting liquidity to fight fires. But this is just painkillers. It won. T-Cure Cancer, Stage 2. Small and medium banks, death list, next 2 weeks. JPM is the fortress falls. How long can outside shanties hold? Watch regional bank ETFs carry closely. Those small and medium banks holding massive commercial real estate loans will intensively release bombshell earnings in the next 2 weeks. ULLC, some unknown bank, suddenly announce withdrawal suspension or seeking merger. That is the signal. Stage 3, credit freeze next 30 days. This is the most painful step, real economy. As bloodstream gets cut off, your credit card limit increase application rejected, corporate bridge loans pulled. At this point, the so-called CPI cooling will evolve into terrifying deflationary spiral. Asset prices fall, but debt remains intact. Class action guide, NOAA. S-ARC boarding passes in this darkest hour. Don't try to be a hero. What you need is survival, then greed. If you are ordinary people, survival is the only mission one. Cash is king, but real, physical cash. Immediately check your deposit distribution. If your money, S in obscure local small banks but never heard of, immediately, right now, this instant transfer out. Move to those too big to fail giant banks like JPM, though it dropped. Government will protect it or convert to short-term treasuries. Don't T-COVID that interest rate difference. Now is time to protect principal. 2. Physical silver SE asymmetric bet. Today, as gold price plunge scared you, that is your gift. Remember, major institutions dumping gold is for emergency. This precisely proves gold as liquidity value. But for ordinary people, I recommend silver more. Why? Because when financial systems collapse, gold is central banks' chips, while silver is people as currency. Current gold-silver ratio is already at historic extreme positions. If industrial demand collapses, silver falls. But if monetary systems reset, silver flies. This is a lottery ticket with extremely high odds. Buy physical, Don T, buy paper silver. Don T, let your wealth become code on someone else. S server. 3. Cut leverage if you are still trading stocks, still using margin, close positions immediately. In this market where volatility is about to explode, any leverage will blow you to smithereens in one intraday swing. If you are elite speculator, this is once in a decade hunting moment one. Short regional banks, short CRE, JPM. S-plunge is the death sentence, and the firing squad first shoots those small fry and CRE. Downside space here is enormous. Every terrible balance sheet is your ammunition depot. 2. Long volatility, long VIX. Current VIX index still lingers at soft landing fantasy lows. This is the world's cheapest insurance. When that bomb truly explodes, the panic index will instantly double. This is the best tool to hedge other asset declines in your hands. 3. Hunt for wrongly killed hard assets. When liquidity crises occur, good assets are forced to be dumped alongside bad assets. Watch those cash flow, rich energy stocks. Watch those quality mining companies wrongly killed by panic. When that wave of indiscriminate selling ends, usually just days, that is your moment to bottom. Fish and build generational wealth. Finally, I want to tell you a brutal truth. On this night of the 14th of January, 2026, the world divided into 2 types of people. One type watches JPM plunge 4%, still foolishly waiting for Fed rate cuts to save them, giant babies. Another type sees through this as liquidity retreat cover, quietly sharpening knives, preparing to carve up corpses, butchers. Financial markets were never places creating wealth. They re-wealth transfer machines. They transfer money from patient, people, S hands to cognizant, people, S hands from believers in news to creators of news. JPM, S plunge, is that starting gun. The ship is about to leave port. Seawater is flooding in. Don T, watch what they say. Watch what they do when big banks frantically dump assets to recall cash. Yet you are fully exposed, running naked. Wake up. Check your positions. Protect your family. Because when the tsunami truly slaps your face, no one will hear your screams. Good luck. We LL meet in the ruins.